I'm Sarah Borkson-Keeter with REIT.com, and joining me for this month's quick study is Brad Case, NAREIT Senior Vice President for Research and Industry Information. Welcome, Brad.
Thank you, Sarah.
Now let's start by looking at October. What were the factors that drove results last month?
Well, it was another very, very strong month for the REIT market. REIT investors during October saw their returns up by 8.72% on the month, far outpacing the rest of the stock market. The S&P 500 gained only 2.4% during October. Small cap stocks did better, but still they underperformed the REIT market by more than 2 percentage points during the month of October. So again, a very strong performance by REITs, but that's really a continuation of what we've seen for a long time. If you look at the year to date, it's been a very strong year to date for the broad stock market, up about 11% on the year, but the REIT market has more than doubled that, with returns very close to 23% on the year. And if you look at returns over the last 40 years, the average returns for REIT investors have been nearly 14% per year for 40 years. So REIT investors have benefited for a very long time from their exposure to the real estate market through the listed REIT space.
And we saw particular strength in the residential sector in October. What other sectors were particularly strong? Sure,
the residential sector was very strong, and that's a continuation of, I think, the fact that there's been very low construction in the residential sector, as well as every other sector of the stock market, and also increasing demand for among renter households from people who have been doubled up over the last few years and are finally beginning to look for rental housing. But if you look at the broad REIT sector, the residential piece wasn't even the strongest. They were very strong, but strongest sectors were healthcare and self-storage REITs, each of which did better than 12% during the month of October. The industrial sector did almost 12% returns during the month of October. Equity REITs on average were nearly 10% during the month of October. Mortgage REITs were better than 5% during the month of October and still provide a very, very strong dividend yield. So REIT investors for a very long time have been benefiting from both very strong total returns that increases their overall wealth, as well as very strong dividend yields that increase their monthly dividend that they can use to finance their consumption.
And as we look towards the end of the year, what particular factors do you think investors should keep their eyes on?
Well, I think the main thing that's driving returns in the REIT market as well as the broader stock market is the recovery in the macroeconomic conditions. Now, of course, as I said, that affects the broad stock market as well. So what explains the much stronger performance by the REIT market? It's really the pace of new construction in real estate. In every property type, nationwide, really you're seeing new construction that's still way below normal levels. And so to the extent that people are concerned about whether the economic growth will continue, well, that may affect stocks, but it doesn't have the same effect on the real estate market because construction has been so low. So real estate has really been benefiting from two sources of strength. One is the continued growth in demand that comes from the economic recovery, which I do believe will continue. And the other is the continued low new supply. And both of those together tend to drive up occupancy rates, tend to drive up rent growth, and tend to drive up the earnings that that REITs earn and that they pass on to their investors. So we've seen real strength in REIT financials, and that is likely to continue to be driven both by the macroeconomic strength and demand conditions and the low supply conditions.
Well, thanks very much for your time, Brad.
Thank you.
And for more news and analysis on all things REIT, please visit REIT.com.